Well, thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah. As our post on Twitter suggests, that the conversation with our guest today would be about how to go about choosing the equities which can survive the COVID storm. And make no mistake about it, we have to admit that we are well and truly in the midst of a very severe second wave. If anybody tells you otherwise, the person is either ignorant or lying. The question is, while it's as difficult to figure out whether this will end or when it will end, your behavior about how you go about choosing your equities could go a long way in serving your portfolio. And that is what we request Vikas Khemani, our guest today from Carnelian Capital, to talk about. How is he thinking about the current scenario? What he says or what he does may turn out to be true or may turn out to be completely false over the course of the next 1-2 months, because we do not know what the future holds in the near term. But it's important to get that thinking right. Because so good having you. Thanks for joining in. I hope all is safe.
Absolutely, Niraj. All safe, and thank you for having me on the show. It's always a pleasure to chat with you.
Thank you so much, Vikas. Because let's try and get the near term bolts and nuts right. What's your sense, Vikas? The belief, at least until this really broke out, was that we seem to be in the midst of, or we seem to have contained this, because even if there would be higher cases, the vaccination would take care of the fears around coronavirus, and it is the fear and the sentiment that would impact the markets and flows a lot more. It seems that for the near term, the outbreak of cases is overtaking the sentiment around vaccination. How do you think that impacts the market, both sentiment wise and flows wise, in the near term?
I think, Niraj, it's a one question that everybody is grappling with, and there is no denial that second wave is hitting us. The situations are reasonably bad across the board, and it will have an impact. So, pre this second wave, the markets were kind of building an hypothesis that recovery will happen rather quickly. March quarter earnings will suggest that March quarter was going very well, but as we got into April and slightly bad situation on the corona front, I think you will start seeing partial lockdowns happening, fear psychosis playing out, and all those things will have impact on smooth functioning of the business, which was very essential to the recovery of the businesses across the board. So to that extent, I think we will see somewhat impact on the recovery pace of the economy, and whether that will last 1 quarter, 2 quarter, that will only depend on how the cases sort of escalate and how the situation comes under control. But for sure, I think Q1 numbers would get sort of compromised. Demand will sort of slow down, because supply chain issues again will come back to the fore. They may not be exactly same or to that proportion as we saw in the first lockdown, because that time we did not have knowledge about how things will get controlled, what will happen. Everything was first time. This time around, I think everybody knows, businesses, government, hospitals, how to tackle the situation. So, proportion of the damage would not be anywhere close to what was last time, but it will definitely taper off the recovery what we were expecting, in the economy, and we will have to that extent see markets can correct, because markets were also kind of in some sense pricing in a good recovery scenario, and to that extent you might see market give away those gains. Can we go to, let's say, 5-7% down from here also? Can it go to 13,500? Quite possible. And but that does not mean that the economy is permanently damaged or the recovery chances are kind of very bleak or lesser. I think recovery will happen, but we will have a sort of pause, or we will have some sort of short-term damage which we'll have to live with for from a Q1 to Q2 perspective. And to that extent, flows will slow down. People who are wanting to invest money might kind of become a little bit careful and wait for more correction. So to that extent, that whole psychology of how it plays out will be there, and that uncertain scenario might remain there for a Q1. And mind you, this will continue to remain there till that, even despite good quarterly earnings of Q4, because markets are always forward looking. So markets will overlook whatever good numbers in Q4 companies are reporting.
Yeah, that's a pertinent point, because a couple of things, because a lot of people will use the 2020 template to think about 2021. As things stand, there is one positive and one negative to that template, right? The positive is that while we have micro lockdowns, they are not as severe, and therefore the impact on business is not as bad. And we'll probably see the recovery happen much quicker than what happened in 2020 because vaccinations are there and businesses are continuing. But um, uh, we are no longer at 9,000, 8,000, 7,000, or forget the levels. We are not longer at the valuations that we were at when the markets corrected to 9,000, 8,000. So therefore, my question is, to your mind, if this is going to be a short-lived thing, and again, we can only talk about right now, your view may change 1 month down the line depending on what happens, but as things stand at the current point of time, do you reckon that a particular valuation level or a particular level on the Nifty might be symbolic of the near-term pain being priced in? Is it possible to predict that?
I mean, again, you can all kind of guesstimate based on, as you rightly said, the light of information you have at this point in time, which currently I believe that things should come under control in next 2 3 months time. By I think probably end of June we should have reasonably that's a hypothesis right now I have, and if that is the situation, then probably will not have a huge impact spilling over in Q2, and again, good part is that these are not permanent damages, so market will overlook again, like Q4 good earnings will be overlooked same way. Market will beyond a point overlook the impact of sustainability of Q1 earnings or recovery. So I feel that probably somewhere around 13 and a half thousand, lots of people who kind of missed the last rally would come in to buy, because post COVID, some of the structural drivers of the Indian economy have fallen to place. They are not going back. Whether we talk about IT, we talk about manufacturing, and they are game changers. They are not game changers for a 1 or 2 quarter. So even if, let us say, some slowdown happens at the economic level, those key structural driver of economic growth is not going away. So it will come back. I have no doubt in my mind that one thing that I can say for sure and certainty, that the recovery will happen, and rather it will happen quickly. But we will have hiatus of 1 or 2 quarters. That whether it will be 1 quarter or 2 quarter, one does not know. But I am reasonably hopeful that things will come under control.
Yeah, because just wondering, does the near-term constitution of what will drive earnings growth in FY22 change materially because of what's happening currently? Because the overarching view was that let's get into value, let's get into domestic cyclicals. Does that, for a large portion of people, I know you've been at the forefront of talking about IT and the higher valuations, but I'm talking about the en masse view. Does that change a bit, you reckon, from domestic
No, I
cyclicals
don't
into
think
global
so.
cyclicals?
I really don't think anything changes because of one. First of all, I think it's not happening at the global level. Secondly, it's happening only at the India level right now, and this proportion of second wave. So I don't think the entire setup of the asset class performance changes just because we have 1 quarter of pain coming through in our view. So I don't think anything changes. Whatever if you are a believer in value and global cyclical coming up, that can do well. I mean, we like to play based on our own investing philosophy, where go after structural growth drivers which can compound your wealth over long period of time. Of course, we are mindful of the valuation. We are never crazy about we don't pay any price. I mean, we don't believe in quality at any price. We are mindful of valuation, but you can find lots of stories at a reasonably good valuation which can compound over a long period of time, and you have to constantly look for those themes. So my point is that I don't think the story of India would change, or any of the investing style would change just because we have 1 quarter, sort of pain.
No, what I meant was, Vikas, sorry, I'm just expanding this conversation a little bit on that. Let's assume that you had, I'm assuming, okay, let's assume you had equal weightage for the near term on IT as well as any domestic cyclical. Let's say hypothetically autos, hypothetically, yeah.
Yeah,
My question is that for the near term, tactically, would you shift the weights between IT and autos? Let's say if you're equally bullish on both, simply because domestic cyclicals might have a bit of an issue versus a global, uh, global catering unit like IT.
absolutely. So I think that is a very valid point. To give you some sense, we created about 7 8% cash in our fund last week, early part of last week, when we felt that this is going to escalate and this will have impact on largely the consumer discretionary side of the portfolio, because we definitely think that demand will slow down, because typically when you're worried about your health and you don't want to buy stuff, right? I mean, that fear psychosis will impact demand. And secondly, the sharp rise in the commodity prices and resulting into the product prices increase will also impact demand. So combination of these, we think that for 1 or 2 quarter you might have impact. And to that extent your point is valid, that those sectors would impact, and we have shifted out of those sectors into cash, and we will look for an appropriate time to sort of get back, as we think either valuations are right or things are settling down. But your point is absolutely valid, that you will see some sort of impact on those sectors.
Actually, as a follow-up to that, Vikas, a space which had corrected quite a bit was banking, right? Bank Nifty is not quite participated in the same way as the Nifty has, and has seen the bitter end of the stick. The numbers from some of the banks were good, but as you said, maybe it's time to oversee the numbers of quarter 4 because they don't mean anything in the near term. My question is the banking pocket, which is firmly a domestic cyclical, already pricing in some of the negatives? And would you believe that the better managed banks, I mean, HDFC Bank provided for pain for FY22, so one would want to believe that they've already provided for whatever possible pain that might come there in that portfolio in FY22, so on and so forth. Some of the others might do so. Do you reckon that the valuations are pricing in for some of the high quality private sector banks, or is it uncertain right now?
I don't think so. I think it's still uncertain category, because as the sort of partial lockdown kind of gets implemented, you will have somewhat impact on the people's earning. So market will again make hypothesis, however small it is. Some hypothesis around again the retail or credit quality, and to that extent there will be worries. So it won't come back in a hurry. So even it will be also part of the same correction phase where. No matter what management say, market will have its own way of sort of factoring in the worries around the potential asset quality, and that comfort will come only when I think things start getting back, and that is the nature of the beast. So I feel that even in this correction, that sector will also probably participate, and you can see better levels to get into. But I'm again very convinced that banking sector is strong as ever. Most balance sheets are fairly repaired. They are ready for credit growth. So as things settle down, those ones will deliver superior returns over next 4 or 5 years. So probably if you see a steep correction, some of the larger banks, good brands, good balance sheets, well run management, you will see good value creation happening out there.
Hmm. Eh, eh, because this is uncertain, because any changes you expect to the primary paper, and by that I mean not just the IPOs but also the government intention to divest some things. I think they've probably stayed on track because we didn't expect anything in the first quarter any which ways. But do you reckon that the IPO papers supply might just get altered a little bit in the timelines? There was a flurry in April, and Monday we'll see macro tech list as well, but that notwithstanding some of the others.
So IPO market is clearly function of how secondary market sentiments are, to be very frank. So it will take a sort of it will slow down. IPOs will get postponed. There's no question on that. So I think they will resume once I think markets kind of get back to normal situation. And as far as the government divestments are concerned, I think government is fairly committed to do that. I definitely see some serious divestments happening on some of the name in this year, as government has outlined. It might get a little bit delayed because government's focus might shift for the crisis management at this point in time, and potential bidders might be still takes up. So process might get little delayed, but I think in this financial year we should be able to sort of get some serious results on that front.
Okay. Now, because before we come to the framework, and I would want to understand from you how you would go about choosing companies in a scenario like this as well. Just a view on couple of pockets, both of which are global in nature, and I want to understand your view as to what happens because of the sentiments like dampening slightly currently in the near term in India. One is IT. You were amongst the first proponents to talk about why there should be or why there will be a valuation re-rating. Now we've seen part of that playing out for mid-cap IT at large and for Infi TCS on the large cap. Some of the others somehow haven't quite been able to. The Tech M's and the HCL Techs and the Wipros haven't been quite able to get up on that valuation up curve, so to say. Do you reckon that because of these fears and because of the whole digitization drive happening around the world, digitalization drive happening all around the world, uh, does this sector stay firmly in focus? Because I'll tell you why, Vikas. I think a lot of naysayers are saying that while people talk about this amazing double digit growth in FY22, it's happening on a very poor performance, so to say, in FY21. And they compare FY20 to FY22 and say that, look at it, the growth is really not as gangbusters as you would like to believe. And therefore, this is about the peak that these companies have reached on the growth and valuation front. What is your thesis here?
So our view is very clearly we are in a fourth wave of IT sort of revolution, so to say, if I can use that word. And I think this digitization and cloud migration is a very big theme. It's a sector where there's a global demand. Supply is only from the Indian companies. Whether they grow at 12% or 15% only, I think time will say. Nobody has an answer on that. One fact is very clear that every organization is looking to spend money on IT, and pandemic has only accelerated it. So it takes time for people to get back to norm, sort of work and start spending money on IT. And to that extent, we have already seen huge amount of sort of order wins by most of the companies, and we will see this only accelerating. So I have no doubt in my mind that IT services as a sector will continue to do well. Now, what rate will they grow? High double digit, or or mid teens, or high teens, or low teens? We will only know in hindsight. We believe that we will definitely see around mid-teens kind of growth, and profitability growth can be even higher, and it might surprise you. And any lockdown kind of fear or any, this only accelerates to that. And secondly, let's not forget, this is a very defensive sector. Cash flows are there, huge amount of dividend payouts are there. Companies are very well run, high on corporate governance, high on ESG score. So you don't get a setup. I mean, I feel that this is far more better growth profile than let's say in a consumer space, which is even trading far higher than these valuations. So I don't see any reason why this re-rating will not will. And the reason why the re-rating is slow, because there are a lot of naysayers who do not believe this kind of growth can be possible. And only who is right, future will say. I mean, I'm not saying that we will be right for sure. Only time will say that whether we are right or the naysayers are right. And we
Of
have put
course.
in our bets where our we have put in our money where our mouth is. So let's see. Only future will say.
Yeah, sure. No, of course. I was just trying to get a thesis of whether you believe that. So you would be comfortable parking in money into IT even at current levels, so to say. Because
For
I'm
sure. I
asking
mean,
you.
investing. I would rather say I'm not parking. I'm saying investing structurally to generate 18 to 20% return. And I don't have any doubt. I mean, it's not that I don't have any doubt in our hypothesis so far that this sector is like, if we change our view on for some additional data point, we will definitely kind of change our view. But currently, we don't have any reason to believe that.
Yeah, viewers, keep in mind these views may change. I mean, so keep that in mind, of course. But for now, because Khemani believes that he's still continuing with his thesis. Because last question on a sector before we move to the framework for choosing companies, and that's on metals, a space which has had a tremendous rally thus far. Now, the overarching thesis is if US indeed is going with the stimulus plan, if the supplies are all constrained, then the bear thesis hypothesis doesn't play out. The Again, not the naysayer really, but the skeptic says that typically when commodity companies start announcing capex plans, large capex plans, that's when you start seeing the beginning of the end, because that's probably peak profitability. What's your thought here? Indian steel firstly, because that's what everybody seems to be betting on, and then the non-ferrous side as well.
So I think currently we are in a very sort of, I would say, it is a 1 to 10 scale, probably we are at 4 or 5 in that cycle. For the simple reason, we have just begun to see. Of course, stock prices have gone up sharply from the low levels, 4x, 5x, but we haven't seen still capacities coming through. Some of them have announced not widespread. I think still we haven't seen any M&A happening. So these are the typical signs of kind of peaking out. Currently, I think still it is underowned by a lot of players. So I don't think we are very early stage of that sort of recovery, and we will if all the hypothesis about spending money on the infrastructure development happens, including India is planning to have very big infrastructure spend. So they can't be a quarter or two kind of sort of driver. They are bound to last 3 years, 4 years. So I think we are slightly early in that sort of hypothesis, I would say. Having said that, it's a volatile sector. It's a globally sensitive sector. One has to be very, very careful. I mean, we stay away from this sector, despite we having a view on it. we stay away from it and we try to play through this, but not directly, through that. Because there are different ways. Everybody has a strength and weakness in their way of playing markets, investing into markets. So we avoid, but I think still it is early in the cycle, not very late in the cycle.
Hmm. Okay, so then Vikas, let me ask you, how are you going about choosing companies? There is a post that you guys put out recently. It speaks about this MCO framework. Now, is that something that you use even in the current times to choose your investments? Because you did mention that you have 7-8% cash. When you start deploying the cash, would there be a direct outcome of an application of this framework? Tell us a bit about it.
So I think again, frameworks are designed to sustain across cycles. We don't do it based on some tactical views. So the reason why this is designed is that we can generate, risk-adjusted return over a 10-year cycle, 15-year cycle, and that is our thought process. So this is basically, there are three parts to it: magic, compounder, and opportunistic. So what we call in magic basket, we try to sort of invest into companies with a view to capture earnings growth and valuation relating. Both happens together. Whenever both happens together, you and I know that there's a huge scope for generating superior returns. And how do you identify those opportunities without taking much risk? And that is where the real art lies. And that is where we have created this whole framework, what we call a magic basket. And there are various reasons. Good businesses, high quality businesses go through different phases of correction, either in the business or in markets. And if you can identify that, which is followed by a catalyst with of an accelerated growth in the earnings of the company, or some sort of correction in the perception of the company in the marketplace, or both of them. When they happen, stock deliver superior return over 3 to 5 year period. I mean, the newsletter you talked about, we in fact did a case study of one of the companies which we invested into under the magic basket, right? And under that, when we bought into, which is Max Life, when we bought into that company in 2019, there were lots of perception issues, there were lots of issues around how it would be seen by the market. But our study was that it was a great business, and we did a lot of work around why it was a great business, right? And when we found that the business is great and market is right now worried about some short term dislocations, we found this keyword was in favor. So what did make it a great business? See, Max created fourth largest insurance company despite having a great brand name behind him. I mean, in the same period of 20 years, they did competing with HDFC, ICICI Bank, and all the SBI prominent brands without having a retail financial services brand, a portfolio which is superior to most other players compared to best in the industry, which is HDFC Life, on every parameter, whether it is product, persistency, productivity. All three parameters, they were best in the class, right? Now, those numbers were there for everybody to see. But we went little beyond that to see how did they achieve that? What was the organizational culture we what achieved that? And when you do those detailed work, you found that it's an exceptionally or incredibly great business. I mean, to give you an example, when everybody was sort of going mass marketing, they chose in early 2000. Today data analytics is a very big thing. They chose in early 2000 data analytics. They collected data, started analyzing data of their own customers district wise, and found that certain districts were completely unprofitable where frauds would happen, and they stopped selling in there and started selling only in the chosen pocket market, and they kept on correcting this. This allowed them to not only sort of reduce their losses, but also price their product better, because compared to industry which was pricing en masse, these kind of innovations they did. They focused on par versus most of the people were focusing on non-par, because everybody was going after the profitable market share, or the quick market share, but they focused on a painfully to be built over a long period of time. Their par portfolio is best after LIC. All other players, 42,000 crore, all other players are much lower than that. So they did lots of things which, when they initiated, was first in the industry. After it became table stake, or people copied, or they became regulations. So they achieved this bit by bit, painfully building a quality of the business which otherwise even competition spoke very high about them. When a competition speaks high about a company, that tells you that what is the nature of the business. Even HDFC Life wanted to buy that business desperately at one point in time. They could not because of regulatory reasons, but that speaks a quality of the business they have built. So when you have that kind of quality of the business, which even in the first lockdown grew their market share, entire industry degrew, they grew, and that tells you that what kind of quality of the business they have built. And we like such kind of businesses. Now, that business was available at 1.3 times EV to embedded value versus, let's say industry peers like HDFC Life, where we compare their matrices with. Now you have this one third or kind of valuation, but at the same time, and why, what was market worried about those, so why this existed? And when we did our detailed work, it was only for two reasons: some sort of impending risk on the promoter leverage, and secondly on the excess deal. And when we did our work, we connected dots, and we found, and we did a lot of work on that. It's not that we suddenly decided, we found that, I think, this is fairly doable. And even if all those things were to transpire, still you are buying business which otherwise a lot of people would be ready to buy. So we were ready to live with short-term dislocation, but capture the long-term upside of the inherent underlying business, which is what played out. I mean, as all those uncertainties have got lifted, we have seen stock has doubled in less than 2 years' time, and still we feel that compounding of the business is left. It is continues to grow. So once and still it is somewhat discount to the sort of comparable player like HDFC Life, but we think that this bridging of the gap will happen as the time passes. More companies, people, investors see it as an access
Hmm.
company. This is the detailed sort of work we did, and this gives you a glimpse
Sure.
of how this company, which we bought as a magic basket, once the valuation re-rating is over, gets into the compounder basket, where we can keep on having compounding on the portfolio for a long period of time. So we constantly look for companies in this basket where markets are seeing, and IT you mentioned as a sector, we had the same perception, I believe, that markets were kind of treating as a defensive sector, worried about the growth profile, and we felt that, unlikely, and we did a lot of work
There is
before
growth.
we kind of,
Hmm.
that it was available at a lower valuation, growth profile is improving, and as it improves, more and more people will start believing into, and more and more people start believing into, the re-rating happens. So this is a
Valuation
journey we
improves.
all walk, and some point in time that will also get into a compounder category once the re-rating is over. So this is the constant snowball effect, as we call it. We play out, and that's one of the favorite framework I have. And we think that this sustains over cycle. We think, and in this, by the way, we don't tell you that we take extra risk. The risk is mitigated by doing the work. None of our business will be low quality, where some sort of governance
Of
issues are
course.
there. None of those issues will be there. So it is all after done the forensic checks on the business and the balance sheet and the promoter, and then only kind
Sure.
of we pick. So by taking lesser risk, you are able finding ways of making slightly higher return, and that is what we call risk adjusted returns.
Is there a risk to the insurance near term issues? Though I know you're talking about structural things, and that's why you've gotten into it. But there was this wonderful report by Macquarie, Vikas, where Suresh Ganpati is saying that while banks may not get impacted as much with the second wave because they are kind of cushioned with the provisions, insurance companies claims might rise, and there is anecdotal evidence of the same, and there might be issues for insurance profitability in FY22 simply because of the number of casualties. I mean, and it might be more problems for general insurance as opposed to life insurance, but even life insurance will not be spared. Is there a near-term risk to this? I'm not talking that this thesis is derailed. If anything, it will probably give an entry opportunity, but I'm asking you that do you reckon there could be better entry opportunities?
There could be possibilities. See, one can't rule that out, but I don't think we have currently number of casualties. Deaths at the country level are so far higher than the normal death rates, and that too also, even if they are higher, they will be spread out across the industry players. So you might see some, if at all it plays out true with what he says, it might be a slight inching up, but that's the nature of the business. They are into the business of insurance, and insuring lives or general assets. So if that is the case, but that does not structurally damage the hypothesis. You
Sure.
might see, it's still underpenetrated. So those drivers are there, and we aren't really bothered about, to be very frank, much on that, because we reasonably are confident that it will compound. And in a credit space, unlike credit space, it does not have those balance sheet risks, or it does not have those short term sort of NPA equivalent risk, so to say.
Got it. Okay, Vikas, last question on the conversation then. You've spoken about this framework very highly. You've spoken about a couple of pockets which fit the framework and you took advantage. I'm sure it's a lot more bottom up as opposed to top down. But still, let me ask you, where are the themes or which are the themes which fit this framework or where you're finding companies which fit this framework, which you might take advantage of if the market's correct? I'm not asking you to give me names of companies. I'm asking you for the themes wherein these companies lie.
So I think one of the things we spoke was IT. Another very big thing, I think, in my opinion, one should look at, and we've again chatted about it in the past, Neeraj, is around manufacturing. We will, I can tell you, in a couple of years, people will keep getting surprised what kind of work will happen on the manufacturing. And good part of the beauty is that it cuts across various sectors. First time in India, we are seeing, huge amount of traction getting built in the manufacturing side, led by government, government initiatives, China plus one strategy, and India's own own setup in terms of cost competitiveness. And a combination of all these things will drive that as a sector in a very different trajectory. And you will see the investment cycle beginning to pick up. So you will see huge investment cycles. So you can look at industrials, capex oriented stories. You can look at in the manufacturing space. We have a huge tail of growth coming through over next 5-7 years. And in IT, of course, we've spoken to some of these sectors. I believe that will do very well. And combination of all these things will have impact on the per capita income of our country, growth trajectory of our company, because in my investing career, I have never seen this kind of confluence of all factors coming together, which are growth enabling, growth propelling. And when this happens, you will have a high growth profile in your per capita income, in your GDP, and that will propel the consumption, thereby again fueling back to the positive momentum. So I feel that all these sectors which we spoke, even will do well, and one has to do work at the company level, at the sector level, micro sector level. But in general, I would say you will see a massive wealth creation opportunity across these themes we spoke.
Okay, Vikas, we'll leave it at that. Thank you so much for taking the time out and speaking to us, and stay safe, more importantly.
Thank you, Neeraj. It's always pleasure talking to you, and you too. Thank you.
Thank you. Viewers, thanks for tuning in to this edition of The Talking Point.